All right. Good morning, everyone. My name is Nafisa Mahabub, and I am the Operations and Partnership Coordinator here at Feed. Thank you all for joining us today for the sixth session of Money Matters. Whether you're looking to improve your understanding of financial language, set measurable financial goals, or explore financing options, this series provides the tools to elevate your business's financial health, with today's session being Financial Language 101. I am pleased to be joining you today from the beautiful Treaty 6 territory and homeland of the Métis in Saskatoon, Saskatchewan. This webinar series would not be possible. Sorry, I'm going to repeat this because I have to actually put a spotlight on myself. I am so sorry, you guys.
No worries.
All right. Sorry about that. Good morning, everyone. My name is Nafisa Mahabub, and I am the Operations and Program Coordinator at Feed. Thank you all for joining us today for the sixth session of Money Matters. Whether you're looking to improve your understanding of financial language, set measurable financial goals, or explore financing options, this series provides the tools to elevate your business's financial health, with today's session being Financial Language 101. I'm pleased to be joining you today from the beautiful Treaty 6 territory and homeland of the Métis in Saskatoon, Saskatchewan. This webinar series is co-hosted by Feed, Female Entrepreneurs in Agri-Food Development, and Tula CPA. Our two organizations are really excited to be bringing you this series, which is designed to unlock financial confidence. Before we get going, I want to tell you a little bit about Feed. Feed is a member-based national nonprofit based out of Saskatoon, Saskatchewan. Our goal at Feed is to support the growth for founders and leaders in the agri-food industry with accessible and relevant resources, learning, and networking opportunities. We welcome members of all types, whether you are an industry member in the agri-food space looking to support food founders, a budding entrepreneur looking to grow your next venture, or an advocate for our sector. This program would not be possible without our founding and funding partner, the Saskatchewan Food Centre and ISED. We invite you to submit any questions you have into the chat box during the webinar. Before we get going, I would like to introduce our speaker, Tahira Fridali. Tahira is a CPA and founder of Tula CPA, providing fractional CFO services to high-growth startups and enterprises. She specializes in finance, leadership, strategy, and operations, and is passionate about supporting visionary missions that benefit people and the planet. Previously a CA at KPMG LLP in London, Tahira audited large corporations. She also worked in internal audit and global finance at McCain Foods, where she gained extensive experience in CPG and manufacturing, visiting over 20 sites in 12 countries. Tahira, the stage is yours.
Thank you, Nafisa. Good morning, everyone, and thank you for having me again this week. I'm excited. We're already at week 6, which is crazy. Okay, as Nafisa mentioned, we are going to be talking about financial language today. So I'm going to share my screen. We're good. Okay. Yeah, so financial language, right? I really think it's important part of being confident in, as a business owner, speaking about your financials and managing your financials. Managing finances, it does require an understanding of like another language. Us finance people, we do get we like every profession, we have our acronyms and our things and like words that we use that aren't actually common words that, like, if you weren't an accountant or finance professional, you actually shouldn't be expected to know these terms. So I always tell my clients, you're not expected to know this, but here is what this word means. So now you know, and now you can use it. So that's my goal with today's session, is for you to learn the proper definition for these terms so that you feel comfortable when they're brought up when you're having conversations or looking at your numbers. Just a general disclaimer before we begin that this course does not replace individual personal financial advice. Always seek professional advice before making any important decisions in your business. And I always like to start with this pause before we begin talking about course content, just recognizing that dealing with numbers and finances is hard for business owners because we were never taught how to do this. So just want you to take a moment to think about if you are feeling any discomfort, inviting you to take a deep breath or pause and reflect on why you might be feeling uncomfortable and what kind of feelings are coming up. Um, if things are coming up for you or you're feeling tense or anxious, invitation to think about maybe after the course, go and reflect about what stories might you have about money or finances or numbers that may be holding you back or may be the cause of these feelings coming up. So again, if this resonates with you, invitation to pause and do whatever you need to do to ease your nerves right now and throughout the presentation. And an invitation to, like with this course and every other course I've taught, is really, can you shift your perspective about finances and numbers if you have a mindset that maybe holds you back from having a good relationship with these topics? Because I believe everyone is capable of managing their finances and being good with numbers. It's just learning a new skill and practicing it over and over again until, and you'll start to feel more comfortable, and that's how you'll be successful. Okay, so kind of talked about this already, but why I think talking about financial language and dedicating a whole course to just financial language and some useful terms and terminology is really important because there is a whole other language that comes up when it's financial and accounting matters related to your business. And you don't have to be the technical person handling the things. This is not a course for how to become an accountant and do the accounting in your business, but this is really how do you understand these terms so you can have understand what so you can have better conversations. Really, it's all about conversations. There's key stakeholders that you need to have good relationships with, and that if you have good communication, it's going to increase the success of your business. And a lot of those, there are a lot of stakeholders in the financial realm. So think about your accountant, really important to have good informed conversations, lenders, investors, maybe suppliers. So just making sure that when they bring up a financial term, you understand what they're talking about, and the exact definition of that term, so that you're speaking the same language. And that's how you're going to be successful in negotiating and getting the best terms for your business. And then ultimately, this is going to help you to create more value in your business. Okay, so the first term I want to talk about today is the concept of accruals. So accruals, it does feel like a sticky word. It doesn't really roll off the tongue very easily. It is a very technical accounting term, but I think there are important aspects of accruals that business owners need to know, and especially product-based businesses. Accruals is actually a very important term. So one, know that when we say accruals, it's actually a method. So think of it as a framework of how we do accounting. And under the accruals method, sales are recorded when goods are transferred to customers instead of when cash is received from your customers. So, and the same thing was with your expenses in your business. You record and recognize your expenses when you use that expense to generate revenue, and not necessarily when the cash is transferred to suppliers. So this is the first step in understanding that it's a methodology we use in accounting, and it's really about thinking about the timing rather than when timing of expenses in a different way than when the cash goes in and out of the account. So just stay with me. We're going to go into this in a bit more detail. So the alternative to accruals is cash basis. So like I said before, think about your sales, and your sale happens under the accruals method when you transfer a product to your customer, and not necessarily when that customer pays you for the product. So the timing of the cash is irrelevant. It's really when the transfer of the goods happens. And it's the same thing with expenses. So if you think about things like raw materials, you're not recognizing the cost of those raw materials when you pay for them. You're recognizing the cost of the raw material when you sell the product to the customer. And that's the most important thing for a product-based business. So just so you know, so there's two methods, there's accruals and cash. We like to use the accruals method as accountants because it gives us a more accurate view of our profitability, because it's based on the business activities and when the business activities happen, and not necessarily when the cash comes in and out of the door. Just so you know, in terms of tax reporting, the CRA allows both methods. So both of them are okay to use when reporting income and expenses to the CRA for filing your taxes, as long as you're consistent from year to year. But most likely your accountant is using the accruals basis when they are preparing your financial information. Okay, so like I said before, the whole thing with accruals is this idea of the matching principle. So, and matching sales and our expenses based on the timing of business activities. So like in that example, the business activity is really when a product is transferred to a customer. That's a business activity, and that's when we want to recognize the revenue on that product we sold and the costs of selling that product when the customer receives that product. And the matching principle says that when a business activity happens, so when the customer receives our product, we recognize the revenue, and then we match that revenue with the corresponding expenses of that product. So I wanted to give you an example just so you can visualize this. So let's take this example. I have a company called Candy Co, and I sell 10 candy bars in January for $5 each. So the cost of each candy bar, so the cost to make each candy bar is $1 to me. And then I purchase $100 worth of raw materials in January. So the question is, what is the correct way of showing sales and cost of goods sold for the month of January under the matching principle? So I laid out two options. One is I recognize sales of $50. That's 10 candy bars at $5 each. I recognize my cost of goods sold for those raw materials I purchased in January of $100. And so my gross profit is minus $50. The second method to do it is to recognize my sales of $50. My cost of goods sold is $10 because each of those candy bars I sold cost me $1 to make. So that's $10. And then my gross profit is $40. So the question to you is, which is the correct method under the accruals method? So feel free to put a number in the chat if you want to chime in. And then I'll go into the solution. Let's see what people are saying. Sarb says option 1. Tess says 40. Okay. So the correct methodology under accruals is option 2, where we match our sales to our expenses. So if I go back here, we sold 10 candy bars for $5. So we recognize the revenue of $50, and then we have to match our expenses. So we bought each of those candy bars we sold cost $1 to make. So we recognize our product cost of $10, and our gross profit is $40. This really shows us what our profitability was of selling those those 10 candy bars at $5 each. Option one is just that. So this is a cash basis showing that we brought in $50, we spent $100, but that doesn't really tell us the profitability of how much it cost us to make those and sell those $50 worth of candy bars. So this, now you can kind of see why we prefer the accruals method, because it really tells us how much it cost us to sell what we sold and then what our profit is at the end of the day. So this is really important for a product-based business, that whenever you sell a product, you should record the cost of the actual products you sold and not all the purchases you made in that time period. And this is one area where I see bookkeeping is not accurate, because, when we're a smaller producer, we usually just record whatever purchases we make in the period, and we record our sales. But then those purchases and all of our direct costs don't actually pertain to the sales we make. So we need to bring in a system so that we can, every time we make a sale, we just recognize the direct cost of the products we sold. So you can go back to the bookkeeping course, and I talk a little bit about that more. And I don't want to get into it too much here, but it's really around having then an inventory system so that every time, and like recording your inventory so that every period you make a sale, you have a system so that the cost of goods would get recorded that are allocated to the sales you made. Okay, so hopefully now we kind of start to understand what we mean when we say accruals, and how we can, if we record our direct costs based on the sales we made, we can have better information on the profitability of our business. And we can feel free to put some questions down in the chat, and we can talk about them after we've gone through all the content. Okay, the next term I want to talk about is a general ledger. Often you might hear of, your accountant talking about the general ledger, or some people just call it the GL. And maybe you've heard this term and you're like thinking, what are they talking about? I don't know what they're talking about. And rightly so, right? Like if you've never taken an accounting course, how would you know what the GL is? But I'm here to tell you, the general ledger, or the GL, is just a list of all your accounts. So if you use an online bookkeeping software or any sort of bookkeeping software, it's all the different accounts you have in your bookkeeping software. And and QuickBooks, it's called categories, so you might know it that way, but it's literally every account that you might categorize a transaction in your business. And we call this the general ledger. And another thing to know is that each GL account is categorized under one type of, so there's 5 major types of general ledger account, and then every account is categorized as one of these. So we have assets, liabilities, equity, which are on our balance sheet, and then revenues and expenses, which are on our income statement. You can go back to last week's content, which is about financial statements, to learn more about these 5 categories. But just know that there's the general ledger, which is a list of all your accounts. And then there's 5 categories, which every account, it will only be under one category of type of GL category. So assets, liabilities, equity, revenues, and expenses. Okay. So other things to know is, so if you start using an accounting system, you don't create the GL from scratch. Usually it comes with the default GL, and then you can go in and further customize that GL. I always recommend that each business does customize their GL so that you're keeping track of balances that are relevant for your business and material, so that you can understand the ins and outs of certain expenses, certain assets, certain liabilities, and have the information readily available whenever you need it. So i.e., think about your sales. If you set up a bookkeeping software, there might just be one GL account for sales. But say my Candy Co example, I might want to know what my sales are for chocolate bars versus candy bars. So I'm going to set up sub accounts under revenue. One is called candy sales and one is called chocolate bar sales. So that's just an example. And I did talk about this in the bookkeeping course. So please go back to that if you want to learn more about customizing your GL for your business. Okay, the next important term to know is sales. And you might think, well, that's an obvious term, but the reason I put this in there is I think sometimes get confused between sales and gross profit and profit. So whenever anyone says sales, that's just the gross amount you get from your customers for any products you sell. So before anything you've paid for, how much you get from your customers when they pay you for a good or service. This number can be net of discounts, but that's the only thing you would subtract from sales. And then other terms that can also be used interchangeably with sales are revenue or income. So if anyone ever asks you, what are your sales, what are your revenue, or what is your income, they are talking about the gross amount that you receive when you sell a product to a customer before any expenses. So what are some useful things to know about your sales and have maybe some numbers in your head are, what are your average monthly sales? And, maybe there's maybe this is not possible because there's so much seasonality in your business, but maybe if you took so another thing to know is, and also what are your annual sales? And, if you're a growing business, maybe you don't know your annual sales because it's changing every year, but maybe having a point of reference. So what were my annual sales last year? And just having that in your pocket. And so if anyone ever asks you like what the size of your business is, a common indicator is your annual sales. And you can give someone a ballpark. Of course, you never have to disclose that information to anyone. But you can use it as also comparing yourself to other businesses in terms of the size. We often use our sales to understand the size of a business. And again, if you don't know your average monthly sales, you could take your total annual sales and divide it by 12 to get an average number and know on average how much you bring in every month. Okay, the next terms are costs and expenses. So these are any business-related purchases and payments. If you're sales tax exempt, then your expenses would include the amount you pay for sales tax. If you sell products or services that are sales taxable, which I assume most of product-based businesses, charge sales tax, then your expenses would exclude sales tax. So if you pay for something, if you pay for a raw material, the cost to your business is the amount net of sales tax because you reclaim the sales tax when you file your sales tax returns. And that's for GST and not some of the provincial sales tax, like I know PST in Saskatchewan. So in that case, you would include the cost of PST because you don't recover the cost of PST. Saskatchewan Finance doesn't pay you back for the PST you pay. So just understanding how sales tax plays into your costs and expenses and examples of costs and expenses. So when we say costs and expenses, we're talking about direct costs and overhead expenses. So your direct costs are any of the costs that go into selling the product you sell. So that would be your raw materials, your packaging, your production costs, any direct labor that goes into making the materials. These are all direct costs, and then overhead expenses can be things like rent, supplies, like general administrative office supplies, any administrative staff you pay, sales and marketing expenses, bank charges, lawyers, legal fees, anything like that. So what should you know about your costs? It's always good to know how much you're spending on a monthly basis, in terms of how much you're purchasing and inventory purchases, and then how much you're spending on overhead expenses. How much do you spend on your expenses annually? So this is more overhead expenses. And then, knowing what are the biggest costs in your business and having a point of reference to understand how much do you spend annually on some of these things. Like things like rent and administrative staff salaries. Those are always handy to know. And also know where to go to get the information if you need it. Okay, the next important term is gross profit. Again, a very important term for a product-based business. This is the profit you make on a product sold before any indirect expenses. So the formula is your total sales less the product cost. So the cost, you'll hear the term cost of goods sold or product costs or direct costs. They're all kind of the same. But it's really like, again, raw materials, ingredients, production costs, direct labor, packaging, shipping, those are all the direct costs. And so taking your sales less how much it made you to make that product gives you your gross profit. And measure is very important to manage for a product-based business, right? This is, we need to be making sure that we make good margin on our product before, and then, there's other expenses required to run a business, but knowing what your gross profit margin is, monitoring it, comparing it year over year, seeing how it's increasing or decreasing, very important metrics to keep track of and to manage as we grow our business. And then the other term is net profit. So net profit is after we've paid for all of our operating expenses. So all those kind of general non-direct expenses. So things like rent, administrative salaries, sales and marketing expenses, office expenses. So how we would calculate net profit is our gross profit less our operating expenses. And then we would also take away any interest we pay on an annual basis and any taxes we owe. And this is how we understand what our net profit is. So it tells us at the end of the day, for everything we sold, how much money the business kept and retained at the end of the year, after all expenses were paid for, right? And really important measure. We're all in business. Part of running a business is making a profit. I always tell my clients, if you don't make a profit at the end of the day, if you're losing money, then you're kind of paying your customer to use your product. So we want to make sure that there is some money left over. We're generating a profit from whatever we're selling. So important things to know about your profit. What was your total gross profit and net profit last year? And then margins are really useful metrics too. So this is where we calculate our profit, either gross profit or net profit, as a percentage of sales. And once it's a margin, then it's a percentage. So then because we can't compare absolute numbers from different companies or year over year if our company is changing or growing, but the percentage, then we can always use that to compare ourselves to industry averages, to other businesses that are similar to us, and then also uses a metric to track our own how our profitability over time. Is our profit margin going up? Is our profit margin going down? If it is going down, we need to figure out how we can make sure it goes up, or what it needs to be at to be a sustainable business. Okay, another common term that is thrown a lot, this word is thrown around a lot. And again, it's a very technical accounting term. So unless you've been taught what it actually means, it can be confusing or frustrating when someone throws it at you and you've never heard it before and you feel like there's this expectation that you should know it. So here to just debunk, to tell you what it is today. So then hopefully from now on, you know, or even just like a quick Google to remind yourself what the definition is. So EBITDA, you might have heard the term, stands for earnings before income, taxes, depreciation, and amortization. So really it's, if I go back to profit, it's my profit, but before I take away taxes, depreciation, and amortization. And you might be thinking, well, why is this relevant? The reason EBITDA is a relevant metric because it really shows, it really gives us an indicator of how much cash your business is actually generating a year over year, because we do our net profit before taxes, depreciation, amortization. One, tax is not an operating expense, right? So we really run it. It gives us an understanding of how much cash our business generates from operations. So tax is a non-operational expense, and then depreciation and amortization are non-cash expenses. They're, we pay for a piece of equipment and that's the cash transaction when it happens. And the amortization is just expensing that piece of equipment over time. And so that doesn't really give, if we include the depreciation in our profit measure, it doesn't really give us the true value of how much cash profit we or the cash profitability of our business. So that's why we use it. It does feel confusing, but I'd say the reason it's relevant is because it's really relevant when you're valuing a business. So when you're thinking about buying, selling your business, or getting investment in your business, that's when EBITDA becomes important. And the reason is because if I want to buy a business, I'm interested in knowing if I buy your business today for, say, $5 million, I want to know every year how much cash I can generate from that business and that gives me a good indicator of whether 5 million is a good valuation. And so, we'll talk a little bit more valuation and stuff, but that's essentially why EBITDA is important, because really at the end of the day, it tells me, okay, you have this business, you're selling candy, but how much cash do you actually make at the end of the day after you've paid for everything? And that's why EBITDA is important. So hopefully that does make sense. But so remember, it's a metric of how much cash the business generates, and it's earnings before income, taxes, depreciation, and amortization. Okay, so explaining more about how EBITDA is related to valuing a business. So another reason why EBITDA is important, because it's often used as a basis to value a business. And what we use is this multiplier principle. So if you've ever been in conversations around buying or selling a business, there's this a common methodology of valuing a business that's for sale is to take the EBITDA and then apply a multiplier to it. And that multiplier times the EBITDA of the business can give us a ballpark value and how much someone's willing to pay for that business. So the multiplier and the EBITDA gives us a valuation. And then, okay, so where does this multiplier come from? So it will depend on a lot of factors, including the industry. So different industries will have different range of multipliers. How big the business is, the bigger the business, the bigger the multiplier, the geography. There's a lot of things that go in, but at the end of the day, professionals who are buying and selling businesses, this is a common methodology they use to value how much someone should pay for a business or buy a business for or sell their business for. And it's really multiplying your EBITDA by this multiplier. So let me just give you an example. So say my company Candy Co. my EBITDA was 1 million last year. And I am now looking to sell my business. So Chocolate Co. approaches me. They want to buy Candy Co. And they decide, so they probably, I'll do my work, they'll do their work, because really all this, we both probably come to valuations, and then we probably enter into negotiation. So Chocolate Co., wants to buy Candy Co., and they decide that the multiplier of 5 times for the size of business and candy business is a good what they're willing to pay. So, so they decide, okay, we'll buy your business using a 5 times multiplier. So important things to know, my company's EBITDA is 1 million. The multiplier that they've decided to use is 5 times. So then they come to me and they might say, okay, this is an offer we'll give to you. We'll offer to buy your business for 5 million, which is that 1 million times the multiplier of 5. Right. And then I can maybe counter this offer or decide to take it. But that's really how that's like a very high level view of how businesses are bought or sold. It's not always using this methodology, but this is one very common methodology that people will use to buy and sell their business. Okay, another important term is accounts receivable. So accounts receivable is an account on the company's general ledger. It sits on the balance sheet under an asset, and it is the total balance that my customers owe me for services or products that I've delivered to them, but they still have not paid. So think of it as, say I sell candy to a wholesaler and I've transferred them 10 pallets. So I recognize that as a sale, and I've given them terms of 30 days. So that invoice is sitting in my AR until it is paid. And so the value of that invoice is my accounts receivable. So again, equal to total invoices outstanding. So for products that have been sold, but the cash has not been received. So if someone asks you what your AR is, your account receivable balance is, so it will be at one point of time, how much your customers owe you for products that you've already sold. So important metric to manage, because if we have a lot of cash sitting in AR, it means we don't have that cash in our bank account, and we might need that cash to make more products. So always important measure to manage and make sure that we're receiving cash on terms that work for our business. And if customers are not paying us, following up, and always trying to manage our AR to minimize it, because it can have a big impact on our business if we don't receive cash when we need it to fund our operations. On the other side, another important term is accounts payable. So again, accounts payable is another account on the company's GL, and this is a liability count on our balance sheet. And this is the flip side of AR. So what we owe our suppliers for any goods or services we've already received but have not paid, because if sometimes we're offered terms. So it's really the sum of all the bills outstanding for services or products that we've already received in our business. And it's usually anything less than 1 year. If you remember last week when we talked about the balance sheet, we split our liabilities under current and non-current. So these would usually our supplier terms are under a year, and as such, it would be all of our bills less than 1 year sitting in our accounts payable. If we owe anything that is longer term in nature, then we'd probably have it as some sort of loan on our balance sheet and not under accounts payable. But again, important indicator of the health of our business. Our accounts payable is how much cash we're going to owe to people in the short term. So, if we're looking at the health of our business and accounts payable, if we look at that in comparison to how much cash we have or our monthly expenses are, we can kind of understand if we're overspending and going to run into cash problems because that we're spending more money than we have. Okay. Last term, shareholders' equity. So shareholders' equity, again, we talked about it last week in the balance sheet module, and really a representation of the company's net worth. So shareholders' equity or equity used interchangeably. So it represents the dollar amount that would be returned to shareholders if the company was liquidated, because it's our net asset. So it's our total assets less our total liabilities. So if we were to liquidate our company, we would try to sell off all of our assets. We'd have to pay off our liabilities, and our shareholders' equity is really what's left at the end of the day. So it kind of represents, if I'm a shareholder in my company, the value of my shares, what they're worth, because if I were to liquidate, that's how much I would get at the end of the day. And then also last week I talked about how it's not it's a basis for valuing a company, but we have to remember that there's other valuable things in our company that are not necessarily represented on our balance sheet, such as like any intangible assets we have, like secret sauce, and then also bumping up any assets we have to fair market value. So that can affect our valuation too. But if someone asks you, or if you've heard about shareholders' equity, it's really that last section of the balance sheet, and it's kind of a representation of the net asset, the total value of the net assets in your business. Okay, so those are all the terms. I just wanted to mention some other terms that, that I'm not going to go through in detail here because we've mentioned them in other modules. So if you're wondering if other things have come up in your mind that you've heard recently that you want definitions for, so income statement, balance sheet, assets and liabilities, you can learn more about those terms in the Financial Statements 101 module. And then cash flow, another important term. And we talk about that a lot in the how to manage cash effectively terminology. So that is all for today. Hopefully that's helped. We will go into questions. And again, just putting my contact details here. Feel free to contact me, connect with me on LinkedIn. I've heard that people are really enjoying these courses. So if you have any feedback or testimonials, I would really appreciate emailing me them, or always happy to have mentions on social media as well. Thank you very much, and we can go into questions.
Awesome. Sorry, I've been trying to look for the video button over here. Like Tahira said, we're just gonna go directly into questions. I didn't see any question come in on the chat, but if anyone has a question now, you're more than welcome to kind of unmute yourself and go for it. Hey, I see nothing, and I also don't see Lori here today, even though she emailed me, but she always has the questions. Okay. Looks like we are good to go, actually.
All right.
Which is absolutely okay. But if you guys want to go through, and if you have any other questions that you think, oh, whoop, there's just a cute thank you note. Thanks so much for being here, Nicosia. Thank you all for being here today. This has been an incredible session. I've been following along with every session with Tahira, and it started off definitely a little bit easier where I knew everything. Now it's definitely going into more things that I don't know about. So this is exciting for me as well. So thank you so very much for being here today. And the next session will be set on November 22nd, and it's for financial goal setting and tracking. So I hope to see you all there. And thanks so much again, Tahira, for being here today and for this incredible presentation. I'm just going to repeat this one more time, that if you do have any testimonials, some good words to send over, you can send it directly to Tahira, or you can send it to me and I will forward it to her. But other than that, hope to see you all next Friday, and have a wonderful weekend, you guys.
Okay. Thanks, everyone.
Thank you.
Bye.